Okay, it's just 10 o'clock, so I think we'll get started. I want to thank everyone for joining us today. This is the third installment, I believe, of the 43North Small Business School. So far, these have been so widely attended, and we're happy that they're seeming to be a resource for the small business owners in our community. Today, I know last week we focused a lot on marketing. We're going to kind of switch gears and move into the finance world here. We're joined by two local experts and professionals from Pursuit. They're a community lender who serves the small business community. We have Malini Krishna here and Sherri Falck. They're going to be talking through preparing for COVID-19 recovery and also filling you in on some things you should know about this next round of PPP. So I think this will be a great resource for all of you. Just a couple housekeeping things before we get started. If we will be reserving 15 minutes at the end of the call for a Q&A. We will get to as many questions as we can during that time. So if you have questions as you go, just drop them into the Q&A box at the bottom of your screen. Do not put them in the chat function. We won't be monitoring that, so just put them into the Q&A space. We'll try to get to those at the end of the call. And I just want to let everybody know we are recording these sessions. We're putting them up on the 43North YouTube page following the webinar. We'll also be sharing out a link via email, so keep an eye out for that. So I think that covers everything on my end, and I will hand it over to Sherri and Malini to get started.
Great, thank you. Thanks for having us. We're excited to be here and share information on financial reporting and PPP. Just want to take a few seconds to let everyone know who's not already familiar with our organization. We are Pursuit. We're a community lender. We serve all small business all across New York State. Our local office in Buffalo is on the east side at 334 East Utica Street. Some of you might know us. I just want to take a minute because when we first entered the market, we were known as Excelsior Growth Fund, New York Business Development Corporation, and the 504 Company. We've rebranded to Pursuit, and we have over 15 different loan programs for everyone to access. Today, we're going to cover a few things, about 20 slides, focusing on financial reporting and PPP, why financial reporting and why it's important. When you know how to create, read, and use your financials, you can evaluate the health of your business, and you can use them to inform business decisions. And updated and accurate financials will not only help you understand where your business is and how it's doing, but it will also help you communicate with lenders and investors as to understanding your business and your financial position. From here, I'm going to kick it over to my colleague Malini, who will walk us through the importance of the balance sheet and financial reporting, and then we'll get into PPP.
Sherri. Welcome, everyone. We thought we'd just get started on something that we think is really important, which are financial statements. Obviously, we are a lender, but we work with a lot of partners who help small businesses across the board, and one in particular who does a lot of mentoring services for small businesses in New York State always tells me this. It says, if you don't know your numbers, your business is just a hobby. And so there are three key financial statements, obviously. Most people talk about the income statement or profit and loss. You know, this is something that you probably look at all the time, right? Your revenues and your expenses. It might be your bank statements, or maybe you have QuickBooks. And then we have two other financial statements that we have found have become increasingly important because of things like PPP and EIDL, which are how are you using your money, which is cash flow statement, and the balance sheet, which is what we're actually going to cover here today. The reason we really wanted to cover the balance sheet is I like to think of it as the financial statement that tells the bigger picture of your business and who you are, right? If you look at your bank account just for today, it's not an accurate reflection of what you have, right? Like maybe you own a car, or maybe you have a bunch of assets at your business. And so while the income statement and cash flow look at just uses of money and just how money is moving, the balance sheet actually tells you where you are. So it's a bigger picture, and this is increasingly important if you are looking outside of your organization for resources. So whether that's asking for a loan, or if you are a startup and you're looking for investors, the balance sheet becomes the most important piece. And so there's a slightly different turn. We usually talk about profit and loss or revenue and expenses. Balance sheet is actually about assets, liabilities, and equity. What that means is total assets are sort of the value of what you have in your business. That might be the money you have, but it could be other things. It might be equipment you have for your business. It might be inventory you have. And that should equal the amount of expenses you have or liabilities. So that might be a loan. It might be that you have to pay out other pieces, plus your equity. And equity, I think, is a really important piece for small businesses because it's something that we often neglect. So we'll spend some time there as well. So what exactly are the components? Let's first talk about assets. Generally, when you meet with an accountant, they're going to talk about current assets or fixed or long-term assets. Just the difference, I usually like to think of like, what can you get rid of into cash really quickly? So those are current assets. Usually those are things that we call liquid, meaning that they can easily convert to cash. And that obviously is cash on hand. It might be inventory. It might be receivables, right? Like if you're going to get paid, you're going to have cash soon. Hopefully you're getting paid quickly. Assets are something that are a little bit more longer term, or the actual assets that you're going to be using for a long time. They could be things like equipment, something that you had to put some money into to generate sales in the long term. So like if you need a new stove for your restaurant, that's more of a fixed asset as opposed to a current asset. You're not going to sell your stove if you're a restaurant because that's not going to help you generate cash. The same thing applies to liabilities. So liabilities are things that you owe either from a current perspective, so less than a year, or longer term. Now, there's no right or wrong with these kinds of things. I always get this question on liabilities is, should I only have current liabilities or long-term liabilities? It's not a good or a bad thing. It's just how you have to dole out money. Current liabilities are usually things like your credit card, if you owe vendors or suppliers certain things, taxes you have to pay within the next year. And longer term ones are loans. We're talking about PPP today. Those are longer term relief loans, other that you owe other people. And this might be just, anything from a small amount to a large amount, but it is also important to understand that that can actually be something that you can use to help your business grow. So if you have longer term liabilities, it's not a bad thing. If you have a lot of short term liabilities, it's not necessarily that you're using your money the most efficiently. It's just allocating it just so you understand what you have. From those two components of assets and liabilities, you can get some information. And these are, I'm just going to give you a little bit of insight. If you were to go to a bank or a community lender, these are some of the ratios that we actually look at to sort of understand, one, your liquidity picture, meaning how you can generate cash, which is what we have here, and your leverage, or how you're using debt. The first one here is the current ratio. These are your current assets divided by your current liabilities. What does this show? It says, how much money do you, or sort of assets do you have that can convert into cash versus how much money you owe? Obviously, if you have a higher number of assets to liabilities, it means that you have cash to pay the money you owe. If it's the other way around, usually means that you don't have a lot of working capital, as they say. So working capital is money to actually pay for things that you have to do to run your business on a day-to-day. We did give you a sample balance sheet there, and you should see that we didn't have a lot of assets and a lot of liabilities, but the idea here is that we also didn't have a lot of things that we had to pay off. So the current ratio there, which is on your handout, is quite high, meaning that hey, there's lots of money to pay for things that are coming through. Maybe you don't need external financing for that reason. If it's lower than 1, that's when you need to start thinking about how am I using my money, or if I need to get other uses or other forms of credit. Many small businesses I know, and I was a small business owner myself, we tend to think of our credit card first as the big one here. But there could be other resources that you could use to effectively cover that money, the liabilities you have. So let's talk about the third component. We talked about assets and liabilities before. The third component is actually the equity. And this is the one that I find that small business owners, including myself when I owned a small business, would often forget about, because this is really what is the component of the balance sheet of who gets access to the resources of your business. And there's sort of three key areas. We hear a lot about this: stock. If you have investors, it's basically who owns your company. For the most part, for small businesses, it might be like you and one other person, might be a family member, but also keep in mind that, you know, at least for me, I had to like look at a lot of different resources to get money to start my company. And you have to work when you do that, when you take external money, especially if you're a startup and you're looking at investors, they're going to want to own a component of the money, because they're not just going to give it to you out of the kindness of their heart, although I wish there were a lot of those people. They tend not to be a ton of those, but you want to understand what they own. What that means is that you need to have partnership agreements. So I'll give you a common thing that comes up often at Pursuit. You have three buddies that get together, they start a company, and then they apply for financing. And one person is doing most of the day-to-day finances and all of these kinds of things. And then the bank comes and says, oh, we actually need documents for all the owners, all the significant owners, right? So larger than 10%, let's say. So just keep that in mind. Like if you are taking money from a lot of different sources, understand what the relationship of taking that money means to your business. Maybe it's out of the kindness of your heart. You know, my dad bought me a printer, the first business I owned. It didn't mean he owned my company. It was a kind gift. But if he had invested, you know, $1,000 in me, he might have said like, hey, I deserve 10% of your company. But really what we're trying to understand there from a lender perspective is who is owed the money that is generated by the business. The next one is paid in kind capital. This is the one that I notice is the most problematic for small business owners. We often if you're a small business owner, you put a lot of blood, sweat, and tears into your company. You deserve to own part of it, right? Like that's the reason most of us are in business, is that we want to be able to generate money into our business. And so paid in kind capital can be a number of different things. It could be actual hours that you aren't necessarily getting paid a salary for. It could also be that you paid for certain things in your company on your personal expenses. This is where we see a lot of sort of discrepancies on balance sheets for small businesses. You know, let's say you need office supplies and you had to buy paper and a printer and a computer and all of those things, and you swiped it on your personal credit card. That is actually a liability that your business now owes to you personally. So that's sort of a form of paid in kind capital. The final component of equity is retained earnings. And as you're making business, as you're going through your business, and this is the relationship between the balance sheet and the profit and loss, right? So let's say at the end of the year, you have $10,000 of profit, net profit from the net income off of your income statement or profit and loss. You then have that cash that can sit on the balance sheet in a number of ways. You can just keep it there and that becomes just retained earnings, or you can take a distribution. This is also an important thing for small business owners. Many of us don't get paid salaries if you're a small business owner and you just take money out. That's what is called distribution. So we want to understand, it's from a lender perspective, are you getting paid a salary? You deserve to get some money. Are you taking distributions out of your business? And how that affects the retained earnings. Retained earnings in general, we want to see going up over time, right? You want to make sure that there's that not all the money that is generated is going out of the business. There's some that's retained into the business. So like if you're making other investments or have some extra cash on hand, you know, that is an important component of retained earnings. So just to do this from a mathematical point of view, let's say you had $55,250 of profit from your business last year, and you took out a $45,000 distribution, meaning the owners got paid out of that. At the end of the year, with including the cash that you had at the beginning of the year, you had $49,550 of retained earnings at the end of the year. So the beginning return earnings was $39,300 from last year. So that's the extra money that was left over there. You added some profit to it. You took out some money for the owners, and that's what you have left at the end. Make sense? So this actually goes into the idea of how you're using debt versus equity. And this is what is called a leverage ratio. So we took that retained earnings piece, right, that equity piece, and said we had $56,000 of debt, meaning like maybe you went to a bank, maybe that's how much you got in PPP money, and that's how it compares to the ownership piece. And the idea here is that we can leverage the value of the company to borrow and invest in our business. And that's what it's actually saying here. A leverage ratio under 1 means that you're keeping more money than you are actually borrowing. You know, the higher the leverage, it might mean that like you keep fueling debt to actually keep your business going. And it might be okay for a while, right? Like, so for example, in the short term, if you have to buy a truck for your business, your debt might go up and your leverage ratio might go up compared to your equity. But over time, you want to kind of balance that out. So again, there's no right or wrong answer here. It's just understanding what you're actually doing with the money and how that's going to generate revenue for you down the line. So let's just talk about some common red flags we see with small business owners. You know, our team has had the privilege of working with hundreds of small businesses across New York State. And our goal really at Pursuit is to make you as bankable as possible, meaning that like we want you to be able to walk into a bank, get an easy line of credit, you know, understand your financial statements in a way that like lets you profitably run, but also borrow effectively. So a big one, high interest rate or rapidly amortizing debts. What's that usually it translates into? Credit cards, meaning like you have lots and lots of, you know, credit cards and you keep swiping and you have a lot of debt on the bags and it quickly amortizes or has high interest rates. You also might be relying on a lot of high cost lenders. We know there are a lot of different types of lenders that are out there, meaning like they charge, you know, financing or factoring or all sorts of different things that might have really high interest rates. If you do have those kinds of loans, we would really consider maybe if you could work with a lender to refinance them so you have one lower rate and a lower monthly payment. That will actually help with consistency. One thing that we often see is that people take like a small short-term loan with a really high interest rate and then they still need money. So they take another one and then another one and then another one where it might just behoove them to say like, what do I need for the year? And actually arrange for financing that is much more affordable and lower cost. The second piece or the third bullet point here is current liabilities exceed assets. This is what we were talking about, working capital. It just means that you have to pay out more money than you actually have in cash available to you. That usually does happen at some point in time for a lot of businesses, especially if they have to make different types of decisions to keep things going. If some of you folks got EIDL money or emergency disaster loan money, this was designed to help for working capital. So you have the liquid money to make sure you have enough working capital to sustain your business over the course of 2020. And then the last one is retained earnings trending downwards or negative while borrowing goes up. What that means is that you keep taking money out and you keep borrowing money. So if there was a trend of either, you know, a lot of distributions coming out, and it might be a sign that you have a lot of partners or you need to take money out of the company, or you're not actually accurately reflecting what type of investment paid in kind capital that you're putting here. This often happens when retained earnings goes down. When at the same time, borrowing goes up. You know, we're saying like, hey, you had money, why didn't you use that money? But your borrowing keeps going up, right? So you're looking for external financing to to sustain your business or grow your business as opposed to the money you already generate in your business. So some things to just consider. These are the 3 things that we think are really important from the balance sheet perspective to keep in mind as a small business. You know, salary versus distributions. Sometimes salary is nice because you can put it on your profit and loss and you know what you're going to get from a month to month or week or semi-weekly basis versus distributions. You know, there, again, we encourage you to work with a CPA to sort of understand what would be the best thing for your business, but keep in mind that salary sits on that profit and loss versus distributions means at the end of the year, after from whatever you're generating from profit on net income on that income statement is what you can take out or can't take out, to be perfectly honest, for some folks. You know, and especially if you continue to go a downward trend, it might be something to consider. The second piece is refinancing debt or repairing credit. Definitely look at this if you have a lot of high interest loans on your books or credit cards. And the final one is keep in mind that if you are supplying things to your business from your personal accounts, either record that accurately on your balance sheet or make sure that you transfer over into business credit cards so it can sit with the business assets. I see a lot of business owners, we work with a lot of them, where they put in a lot of money into their business, which is really admirable. You should get paid back for that. It should be reflected in that, you know, and because over the long term, you can't infinitely say like, oh, I can just keep putting on my personal credit cards. It should be reflective of like what the business can actually generate money for and pay their expenses with. With that, I'm just going to transfer over to sort of talking about why this has become important. This has become really important from our perspective as a lender, because this is the last year has often been the first time we've seen businesses take in money to have a balance sheet. And we don't see that often reflective if they need more money as they come to us. So make sure that your balance sheet reflects the fact that you have outside money that has come into your business, those credit cards and loans that we talked about. EIDL is a big one. If you got the emergency loan, there was 2 components to that. There was a grant, which is cash, and that is not a debt, keep in mind. So if you got the EIDL grant, that is not a liability on your balance sheet. It's just cash that they gave. It was a grant that the government gave through the SBA, but they also had a loan component. And if you don't know, you can vary it in the email usually that you got from your response or the paperwork you got from EIDL, it will tell you which part was a grant and which part was a loan. So make sure you reflect that like the grant was cash as an asset, which is loan as your liability. And the same thing with PPP. We are going to touch about forgiveness. This is the most common question we got. But if you did get PPP, right now there is no firm guidance from the SBA on if the loan will be forgiven. So it is still technically a liability that your business owns. So, or owes, excuse me. So please keep in mind if you have EIDL or PPP, have that reflect on there. And if you're talking to external partners, they're going to want to know that. Mostly because, at least from where I sit, if you don't have it on your balance sheet, or you don't know if it was a grant or a loan or the amount you got, we're going to say you should go get that. That is an important resource that the federal government has provided for small businesses. And before anything else, those are the 2 you should actually be going after first. So, you know, it's not so much to say like, oh, you did something wrong. It's saying like, take advantage of the resources you have. Now, I know Erie County did a great grant program. A grant program would also be appropriate to put on here to say that you have the cash to make sure you have the working capital. There was a number of other chambers of commerce that did low interest loans, and we would highly recommend going after those as well, but make sure that's reflected here. So with that, I'm going to switch over to PPP Share. Do we have any questions that we want to address, or is there something else that we want to go over before we go over PPP?
I think we're going to save the questions to the end, but for those that are not familiar with PPP, and I think this audience probably is, but I just want to set the stage. The Paycheck Protection Program is an SBA loan It helps businesses keep their workforce employed during the pandemic. So we'll walk through first draw and second draw, and also want to let folks know our own experience in the last round in 2020 for PPP Pursuit. Did process over 7,000 applications, and we had an average loan size of $23,000. So that truly reflects us helping the small business community. So Malini, I'll kick it over to you and we'll get into PPP.
Great. So for those of you who are new to PPP, the Paycheck Protection Program was designed specifically to maintain payroll. And I know there's a lot of confusion between what happened last year and what just was announced a few weeks ago. So we're going to talk about both of them. Both programs are still open, meaning the one that was established in 2020 is still open. And if you did not receive any paycheck protection money, you are required to go through the first draw first, meaning like you can't go to the second draw and just apply for the second round if you didn't get the first round. And I'll explain why. So the first round of PPP says that you can take your average monthly payroll, meaning the payroll you had for W-2 employees for the year, divided by 12 times 2.5 and apply for a loan of that amount. That it is capped at $2 million. I haven't worked with anyone who has $2 million of 2.5 months of payroll, but that's the general calculation. There's a 1% interest rate on that money that you borrow, and it's for a term of 5 years. There are no fees with this. It's just a straight, we are just an administrator. If you come to someone like Pursuit or one of your banks, we're just an administrator of that money from the SBA. So it's for 5 years for 1%, but there are no payments that you make for basically a year, which is until the loan forgiveness is determined by the government. If you comply with those rules, some or all of the loan can be forgiven. Right now we're hearing sprinklings that generally like the loans under $150,000 will probably be forgiven, and we'll talk about the forgiveness process, but again, it's not set in stone. There are no collateral requirements for this. So 2.5 times your monthly average payroll, 1% interest for 5 years. To qualify for the first round, you have to have employees of less than 500, and a whole host of types of businesses can apply for this program. Small businesses, certain nonprofits, sole proprietors, independent consultants, tribal businesses, small agricultural co-ops. And I really want to stress here for sole proprietors and independent contractors, if you were a 1099 employee, or if you paid contractors from 1099, they are then eligible to apply for PPP. So I know I work with a lot of small businesses, and they say, oh my God, I really want to pay my contractor and make sure they can apply for the PPP loan themselves. So PPP was really designed for folks that are on W-2s or full-time employees on your payroll. But if you had contractors, they can apply for PPP independently. The thing that's highlighted here on this slide is the big difference between the first draw and the second draw. The second draw requires a demonstration of a 25% revenue reduction to qualify. So that's why I say if you did not get PPP in the first place, it doesn't matter, apply for the first round, because you don't have to demonstrate that you reduced revenue in 2020 to get to the second draw. So let's talk about the second draw requirements. There's some slight differences here. The first one is that there are 2 loan amounts that you can apply for depending on the industry you're in. So it's staying at 2.5 months of monthly payroll costs up to $2 million, with the exception for businesses that have NAICS codes. And if you ask your CPA, they can tell you what that is, that start with 72. That's primarily food service businesses and accommodation industry. So restaurants, cafes, bars, hotels and motels, small B&Bs, all of those can borrow up to 3.5 times monthly payroll. So 2 different things, 2.5 for everyone else. People with the NAICS code starting 72 can get 3.5% or 3.5 times monthly payroll. Again, 1% interest, no fees, 5 years. We're assuming that the loan forgiveness will look similar to the first round. If you comply with the rules, you can have that loan forgiven, and there are no collateral requirements. Here are the eligibility. If for second draw, you already received the first PPP loan and you used the full amount of that PPP loan, or you will do so before you get this money for the second round of the Paycheck Protection Program. Slightly difference here, you have fewer than 300 employees. The first round was 500, this one is 300. And you have to demonstrate on the second draw that you had a revenue reduction of 25% or more for any given quarter in 2020 as compared to 2019. The way to do that is if you have 2019 financial statements, which is why we wanted to talk about financial statements here, you can match that with 2020 financial statements, and it has to be for the same quarter. So it could be Q2, it could be Q1, you know, and I think this is really important for our small businesses. We actually recommend looking at the quarters you might have had to been closed or forced to be closed because of regulation. That might be a quarter to look at to compare, but you will have to show financial statements when you apply for the second draw for that reason. The other thing is we have to have proof that for that program that you are not permanently closed. Temporary closed businesses are okay. We have worked with some folks that maybe are not allowed to reopen, or the way their business operates is it's not possible to open now, but they do have plans to reopen. If you have permanently closed your business, you cannot apply for the second round of PPP. So let's talk about how you can use the loan. And I think what's really important here is this is going to be especially important if you're applying for forgiveness. Much like the name of the program implies, it was really designed to help support salary and paychecks. So the loan itself, at least 60% had to be used for salaries and payroll costs. That doesn't mean 100%, but at least 60%. And that's going to be especially important to demonstrate if you're applying for forgiveness. And of course, it could be more than 60%. The program was really designed to support salary and wages, but there are other things you can use with the other 40% of the money. It could be the utilities for your business, rent, interest on loans and mortgages. So if you have outside loans, you can use that for the interest payments on there. If you had to buy software for cloud computing or human resources, any property damage that was not covered by insurance due to the pandemic in 2020, if you owe suppliers money and those supplier agreements were in effect prior to receiving the loan, obviously PPE and protective equipment or any upgrades you had to make to your business specifically to comply with COVID regulations are all acceptable uses of the loan. So let's talk a little bit about forgiveness. I know this is a question we get overwhelmingly here at Pursuit, so I'll just start by saying there's no law or firm guidance on the forgiveness of this. However, the SBA has put a lot of guidance out there to get you prepared. So what does that mean? If you have all the information, there's no place for you to physically send it to the SBA to say like your loan is forgiven. But what we recommend is saying, here's the stuff you need to gather so you have the information. Once they say, yay, we're taking forgiveness applications, you're going to need your bank statements for 2020. You're going to need your payroll reports because this is for a payroll program, and or canceled checks. So that those are two acceptable forms. And there are specific forms from the SBA. It's the 3508 form, and you can just Google that or go on the SBA website. There are 3 separate forms. One is for larger businesses. That's the general one, which if you got up to $2 million, you probably have a lot of payroll things that you have to do. But there are 2 sort of simplified ones, the Easy and the S, depending on your revenue size and the number of employees. And it's a very clear guidance right there on the SBA website which one to use. If you have to do the Easy or the S form, it's roughly 2 pages plus the other reports you have to do. If you have a larger company, the 3508, is what you're going to have to use. And we would highly recommend going to a CPA if you have a CPA or someone you can talk to make sure that you are gathering the right information so you have that ready. And again, if you work with Pursuit for your PPP loan, we are not taking those applications, mostly because we think, and this is just a hypothesis, it's not fact, that there's going to be something even easier the SBA will come up with. So if you're nervous and you want to feel prepared, get your bank statements, payrolls, and the form ready. If there's guidance from the SBA that it's much easier, just filling out an online form, that's what we're actually waiting for, because currently our borrowers are not making payments on those loans. So we figured we might as well make it easier. I think that's the case for a lot of institutions that did PPP. They might be holding those statements for you, which is fine, but there's no place to send it to actually get your forgiveness quite yet. With that, I will just end here and say we have a lot of resources from Pursuit that we think can help you. Our priority is really making small businesses thrive. So we have a COVID resource center on our website at pursuitlending.com. And we do make regular updates, especially about PPP, EIDL, and emergency funding or disaster relief funding. We do put out regular updates on Facebook, Twitter, and LinkedIn. So that's a good way to say like, hey, something's updated here, you should take a look. So follow us there. And with that, I'll open it up. We have questions, concerns, feedback, all are welcome.
Thanks, Malini. Yeah, we do have a couple questions that have come in. So I'm going to actually just kind of work backwards here, and we'll start with the most recent. One question, sorry, they're jumping in as we go here. One question, could we count state research grants as revenue?
So revenue sits on the profit and loss or income statement, and that is revenue there. In terms of an asset or liability on your balance sheet, if it was a cash grant and you don't have to pay it back as an asset.
Another question that came in, can you share more about how a sole proprietor would qualify for / use PPP?
Sure. This is a common one because you are filing your taxes essentially like your own business. You can apply like you're a business. So your payroll would be your payments from your tax forms, and you should work with your CPA on this. And you then qualify as essentially a business that you're protecting your paycheck for 2.5 times your monthly payroll for the year.
Another question, under the current PPP guidance, are wages paid to FTE employees hired through an agency forgivable?
I don't think there's clear guidance on that one yet. So I'm going to say wait on that because we don't know what the forgiveness guidelines are. There is no forgiveness guidelines yet. This would be a great question to bring to a CPA when you're filing your taxes.
If you own commercial real estate and haven't taken income for 2 years because you reinvested rents into updating buildings, can you apply for PPP? Their comment at the end was having COVID rent losses hard.
I guess I'm a little unclear on the question. So when you apply for PPP, it's disaggregated from everything else in your business. It's really looking at your payroll. So it's looking at your payroll expenses. If it's revenue reduction, that's looking at your profit and loss. So I don't know how you're accounting for those assets, to be perfectly honest. So I would say work with your CPA on that to see how you're accounting for those losses from the commercial real estate and how it shows up on your financial statements, because that's going to determine if you got the 25% loss or not.
Another question, what is the definition of supplier payments?
That's a good question. Supplier payments are, let's say you have contracts with vendors that provide you things to make your business run. It might be shipments or raw materials or components. And so if you have those contracts in place, It might be that if you're a restaurant, you have suppliers that bring you regular produce and you had those agreements in place before your PPP loan, then that's usable for the PPP loan.
Okay. Is the EIDL advance from last year considered revenue when comparing the 2020 to 2019 revenue per quarter?
It is considered revenue. And this would be a good question for your CPA of when you booked the revenue. So the grant was considered revenue. When you recognize it on your financial statements is how CPAs can help you on that. So, you know, some people got EIDL in May, some people got it in September, some people got it in December.
Another one here, rumor-wise, so do you have a hunch that the EIDL will possibly be forgivable?
$1 million question if I had the answer to that. Sherri, do you have any thoughts on that?
I haven't heard anything about that, no.
We haven't heard, to be perfectly honest. If this is any indication, EIDL was not designed just for COVID. EIDL has been part of the SBA for decades. They just open it up when there is disaster and relief necessary. I think they did it after several hurricanes and things like that. So you can look at what they did in the past. It's been all over the place, but we don't have a hunch, unfortunately.
Okay. How do we account for personal loans to the business? Do we need to show a loan contract?
As someone who likes to have financial diligence, paperwork and contracts, especially, we always get this question. If someone in the family lent me money, do I have to put that in there? We always recommend the answer is yes, especially if you're using your balance sheet when you are talking to external resources, because they're going to want to know, like, are you going to keep putting in money? Are you going to be paying yourself back?
Another question, what money is available for small businesses with no employees?
Sherri, you want to take this one?
With no employees. That's a good question. I'm sure there are programs out there. We have some at the state level. We can explore what the business looks like overall for these other federal programs. If that person wants to get in touch with me. My number is 436-2977, or my cell here is 364-2081. And we can look at your overall picture and let you know which programs you might qualify for.
Can money taken out of a business be considered a loan instead of a draw?
So your business is lending money to another institution or a person, I guess. That's a question. That's a CPA question because there's some logistics around that.
Okay. What if you are an LLC, sole proprietorship, but have no W-2 employees? You just take draws from the business through the year as a payroll and file a Schedule C?
Mm-hmm. I mean, that's what most LLCs kind of do. So that's a very common practice. You know, as we said, there's no right or wrong of payroll versus distributions. It's just being clear about that the way you get allocated money is through distributions.
Another EIDL question. I applied for EIDL last year. I got $1,000. May I apply a second time? And do you have a sense of how much I would get?
Again, $1 million question. We have no idea how EIDL came up with their calculation for many. Like, I know I personally have called absolutely everyone I possibly can, and no one has an idea of how that came up. So I wish I had an answer for that. I will say that EIDL was extended into 2021, so you can apply. It sounds like some people are reapplying. Again, because Pursuit has no involvement in EIDL, we have no we're not even an intermediary. I don't know how they're making the decisions. It's the SBA that's making the decisions on that.
Okay. Is there any way to get more than the 2.5% of payroll costs for the PPP loan? So if our company wanted to get more out of this loan, even if it was not forgiven, in order to use it on qualifying expenses, is that possible?
My understanding from our intake team at Pursuit is that that is the loan amount they can submit is based on the payroll, because it is a payroll program. From the forgiveness side, I wouldn't, the guidance was 60%, and it definitely probably won't be forgiven if you don't use the 60%. And then there are other resources. So, Sherri, if you want to talk about some other resources that we are advising for people who need something besides PPP, there are a bunch of resources that are available that may not be paycheck related in terms of loans.
Right. So we've worked with a lot of small business owners who their capital need wasn't met by PPP or even EIDL. So when appropriate and when it makes sense, there are other programs such as the New York State program called New York Forward Loan Fund, and even some of, explore it with your bank, explore it with other community lenders. You can explore other options with Pursuit. For any of you on the webinar today, I encourage you to get in touch with us and we can, look at you individually and give you some guidance. Our contact information is up here. And we'd be more than happy to, might be a fit for your business.
Thanks, Sherri.
Thanks, Sherri. If you change your business name and structure from LLC to DBA for rebranding and a business partner leaving, and your business revenue channels have not changed, can you apply for new PPP? Would it be a reapply or a new company? The old LLC got PPP and already applied for forgiveness.
So it sounds like you are applying for the second draw with the same LLC name. It's a DBA now. That's another form that you filled out. So it's still an existing entity. Unfortunately, the Paycheck Protection Program was not designed for startups. So it is looking for companies that were in business in 2019 and 2020. So I guess we'd want to talk to you specifically about that specific situation. But if the LLC is the same and you have business tax returns for that LLC for 2019 and 2020, that would at least get you in the intake. This is also a really good reason to have a balance sheet to show partnership agreements if you are looking for financing, because we'd want to see the change. Any lender, not just Pursuit, but any lender would want to see the change in partnership and what that meant for the business and who has rights to their retained earnings.
Okay. Next question is, I think you may have answered this, but I'll just throw it out there again. Is this the second draw for PPP only, or can you apply for a second loan in EIDL?
So what we talked about today was on the requirements for PPP, because there's very sort of firm guidelines on there. You can go to the SBA website for EIDL and submit applications, whether they take them or not. It is still, the portal is still open, and they extended it till the end of 2021. Again, those are decisions that are made by the SBA, and I have no idea what their underwriting criteria is, but I know personally, and Sherri, you can talk to it too, we have encouraged people to apply.
Next question, if you are the only employee of your business and take part of your payroll and payroll checks and part in year-end distribution, can the distribution be included in your payroll calculation for the PPP loan?
My understanding is it's payroll costs, but you could work with a CPA depending on how it's allocated. So I would ask a CPA on that.
Okay, and I think we have one more question here. Are you able to discuss COVID-19 employee retention credits? This person had asked their payroll processor for an update, and then they were told that the window closed on January 5th and they're waiting for new guidance. Do you know what the new guidance is?
That is a great question. I don't know the guidance. I don't think it's been released yet. Sherri, have you heard anything different? Because I haven't heard anything different.
No.
Okay, well, I think that covers it. Thanks everybody for your great questions, and to Malini and Sherri, thank you so much. There were a lot of comments in here just saying how awesome this was and what a great topic and resource you've been. So I know we have your contact information here, and we'll be following up with the link afterward. Like I said, the session will be posted to the 43 North YouTube page. And will also be sent via email. And, we hope to continue this great attendance as we go through these next sessions of the 43 North Small Business School. Tune in on Thursday at 10 a.m. for the University of Buffalo Legal Clinic. They'll be talking about the ABCs of business law. So thanks for attending, and have a great day, everybody, and go Bills.